Okay, let's continue with our calculation from the previous week. So again, beginning balance plus whatever comes in the account minus the ending balance going to give you what went out from the account. On the merchandising company, we're chasing cost of goods sold. Cost of goods sold coming us out of the inventory account. Whatever we purchase plus what we have in the beginning, that's how much we have available to sell. Minus the ending balance, or minus what's left, we're going to see how much is the cost of the goods that we sold. Because we purchased those one, they're coming with the cost. When we sell them, that cost become the cost of goods sold. And then we can compare how much we actually making profit once we see for how much we sell them. So the whole point here was beginning, how we're going to get different elements here. If we're chasing how much went out or how much we spent, we're going to have beginning balance plus debit minus ending balance. And it's going to give us how much we sold. If we need to find out the ending balance, we're going to have beginning balance plus the debit, or plus purchases in this case, minus the whatever went out. We're going to find the ending balance. If you need to find the beginning balance, we're going to have the whatever we spent plus the ending balance minus whatever we get in the account. And we can find different elements here. Now, simple, let's test you a little bit for this one to see if we still remember it. Let's go with cash. I have $20 cash. I spent $200. And when I went home, I found $100 in my pocket. How many dollars I withdraw from my bank?
280.
Let's see. If you put here 280 plus 20 is going to give me 300. Should be equal to the 200 plus 100, 300. Or the other way you can put it is whatever I spent plus whatever I have, 300, minus whatever I have in the beginning. That's going to give me amount. Okay, so now let's move this. This is when we have, so once we have the merchandising account, when we work in merchandising company, how are we going to get cost of goods sold? Cost of goods sold is going to be equal to beginning balance of the inventory plus we're going to add the purchases. That's going to give us how many goods we have available for sale. Inventory available for sale. And the last piece that left should be this inventory available for sale. And when we deduct less ending balance of the inventory account, it's going to give us cost of goods sold. That's how we're getting cost of goods sold when we have merchandising account, when we're running merchandising company. Make sense? It's important for me to understand that you understand this. So give me some hints. Do you get this?
Yes, bro.
Okay. So let's keep going then. Now we're gonna move this one. We're gonna label it merchandising company. Let's move now to the manufacturing company. I'm gonna still use this merchandising. I'm gonna move it here because I'm gonna do some adjustments. Adjustments will be, I don't need this part. This one was for the understanding of how this everything works. I don't need this anymore. So now in order we to flip to the manufacturing company, and manufacturing company, we have to understand how many inventory accounts we have. And in manufacturing company, cost of goods sold is not coming from the inventory. I mean, it's still called an inventory account, but it's not called inventory. It's called finished goods. So in order to sell what we want to sell, in order to sell what we want to sell, we have to produce it. Now the question is then, how are we going to get cost of goods sold? Well, we have to make some adjustments. First, I'm going to flip this one on the as much as I can further. So in order to get, I'm going to make this a little bit smaller. In order to get our cost of goods sold, we need to start adding some accounts, and we need to change the names. First account that we're going to have in the manufacturing company should be raw material. From raw materials is the one that the raw material that we're purchasing, which raw material will be our direct material, which we're going to work on it in order to convert them to finished goods. Finished goods is the one that we're going to sell here. So this one is good, but we needed different name, and the different name will be here, finished goods. And the finished goods are the one that we're going to sell. Make sense? So in this case, the cost of goods sold is not going to come from the inventory account. Still going to be inventory account, don't get me wrong here, but the account name will be finished goods. So from finished goods, we're going to get cost of goods sold. Let's delete those numbers. We're going to plug some numbers later. And that's how we're going to get our cost of goods sold. But on the cost of goods sold, we have to do some adjustments here. First adjustment is, since we're getting this from the finished goods, our beginning balance here has to be the beginning balance of the finished goods account. Then we're going to have purchased it, but that's not going to be purchase. That will be production. And since we're manufacturing, whatever we're manufacturing, and that manufacturing comes with the cost, we're going to call cost of goods manufactured. Once we manufacture those goods, we're going to have finished goods available for sale. And once we sell those finished goods, once we see what's the ending balance of the finished goods, we're going to see how much is our cost, which we're going to use for our income statement to calculate the gross margin. Now, the question is, now in finished goods, as you can see, we have the beginning balance, but we have something that's coming in. Now the question is from which account that's coming in. That's why here in the middle, we're going to have one new account, which is going to be work in process account. Work in process account. That work in process account is going to give us access to the finished goods. So what we're going to have in the work in process account? We have to have three elements here in order this to work. What will be the three elements? First will be the direct material. Second will be direct labor. And the third one will be manufacturing overhead. Once I have those three costs, then I can say, okay, I have my product is finished. Once the product is finished, become cost of good manufactured. Once I manufacture it, that manufacturing comes with the cost. What's in the cost of good manufacturing? Again, remember, direct material, direct labor, manufacturing overhead. That's what is our product cost, those three. Once I have cost of goods manufacturing, I'm going to move cost of goods manufacturing to my finished goods account here. So let's put this one on the side. So we can plug later some numbers here. So our cost of goods manufactured is going to be cost of goods manufactured. So we write here, and those cost of goods manufactured is going to come to the finished goods. Cost of goods manufactured is going to come here, and after that they're going to go out as the cost of goods sold once we sell them. So now the question is, I need direct material, direct labor, manufacturing overhead. From where the direct material is going to come? Well, direct material is going to come from the raw material account. So material use is going to come from the raw material account. Now, once I have this raw material, then I can use them in my production as a direct material. So, but in order to have those materials, what do I have to do? So I have to purchase my raw materials. So now you have the whole process. We're purchasing the raw material. We're using the raw material. We're using direct labor. We're paying our employee. We're using manufacturing overhead. Once we use all those three, we have finished goods. That finished goods come with cost to manufacture that finished goods. That's why we have cost of goods manufactured. Once we get cost of goods once we find out how much is the cost to manufacture our product or goods, we're moving to when it's ready for sale, we're moving it for the finished goods account. In finished goods account, it's gonna stay as long as we sit in our warehouse. Once we sell it, it's gonna become cost of goods sold. Why? Because we just sold the item. Once we sell it, it's gonna be cost of goods sold. So what we're trying to find out, how much profit we're making. So again, in order to making the profit, we have to find cost of goods sold. In order to find the cost of goods sold, we have to find cost of goods manufactured. But we cannot find the cost of goods manufactured if we don't have the cost of product cost. And we cannot find the product cost and if we don't know how much direct material we have used. So you can see we have to go with our calculation 3 times here. So again, objective is we to find how much is the cost of goods sold. That's our objective. Let's copy it here. Instead of cutting it, I'm gonna copy it, I'm gonna paste it here. This is our objective, people, to find cost of goods sold. Now again, how we can find cost of goods sold? Well, we have to find out how much is my cost of goods manufactured. How can I find the cost of goods manufactured? By finding all those three. In order to find those three, I have to start with direct material. So let's start and see how this one goes. I even push it further here, and we can start. In all those accounts, I want you to remember, we're gonna apply this formula in all of these accounts. What we're chasing? We're chasing the credit. Or in this case, how many materials we used? In this case, how much is my cost of goods manufactured? In this case, we're chasing how much is my cost of goods sold. That's what we're chasing. Now in this account will be the debit will be equal to purchase, credit will be equal to the direct material used. In this account, debit will be equal to direct material used plus direct labor plus manufacturing overhead, which is our product cost. Don't forget this is a product cost. Credit will be equal to the cost of goods manufactured in this case. And in this account, if we have to do the same, in this account, the debit will be equal to the cost of goods manufactured, and the credit will be cost of goods sold. And that's how we're going to find everything. So now, let's start with the first one to find out how many materials we actually used. How can I get my direct material used? Any suggestions? Having in mind this format here, how can I start? Give me some ideas. What will be my starting point?
Beginning balance?
Beginning balance, of course. Beginning balance of the raw material. Raw material account. Once I get that beginning balance, my raw material account, then what we're going to find out? How much is my purchase? I'm going to add my purchases. And once I get those two, what I'm going to find out? How many direct materials I have available. That will be direct material available for use. Once I find out how many direct material I have available for use, what do I need to know? I need to know I need to deduct ending balance of the raw material account. And once I do that, I'm going to find out how many direct materials I actually use. Make sense?
Yes.
So it's the same thing like your pocket money. You have $20 in your pocket, you added $100. So now how many dollars you have available for spending? 120. You went home and you found $15. How many dollars you have spent? That's what we're looking for. So now we have to repeat this thing one more time in order to get the cost of goods manufactured. So how are we going to get cost of goods manufactured? Well, we need to add the beginning balance, right? We're going to get the beginning balance of work in process account. Then we're going to add the product cost. Then we're going to add direct material use. We're going to add direct material. We're going to add direct labor. We're going to add manufacturing overhead. And once we add those one, we're going to have some total production cost. To be transferred to the next stage. Once we get, that will be our product cost. Don't forget, this is a product cost, but the total production cost have to include the beginning balance. Once we deduct less ending balance of the work in process account, we're going to find out how much is my cost of goods manufactured. So remember this calculation, because this calculation you have to do once on your assignment, and second time you have to do it on your midterm exam. And once we have cost of goods manufactured, the next thing is to find is cost of goods sold. Now the cost of goods sold, I'm just going to copy and paste this thing here, this calculation, and I have my cost of goods sold. Make sense?
Yes.
All right. So now let's repeat this one more time and to see this thing one more time through your slides. So let me highlight those one and to make it nice. Because later on we can, if you want, we can even plug some numbers so we can actually use the application of all this calculation. Otherwise, calculation without usage is just waste of time. Try to use everything that you learn, everything that you know as fast as possible. Otherwise, it's going to be just waste of time. Okay, so slides. Let's move back to slides.
And what are we doing here? It's an income statement.
Yes. What do you mean? On the
Like,
income
for
statement,
example, yes,
from the income
diesel.
statement, we're chasing only and only cost of goods sold,
Okay.
right? That's our objective here, to find out how much is our cost of goods sold. Once we find out how much is our cost of goods sold, then we can prepare the entire income statement starting with the sales, right? That's one of the thing. Otherwise, if we don't find this cost of goods sold, we won't be able to get the income statement. Make sense?
Yes.
This is the number that we're chasing, and that number is very important for us because once we have cost of goods sold, so imagine this: you in business of producing, let's make it simple. Let's go back to the manufacturing company, because manufacturing company you're getting a little bit more sense, easy get sense for the cost of goods sold. Then we're gonna make it complicated. Imagine this: I'm in the business buying, selling computers. Do I need to know my cost, the cost of my computer? Again, I'm in the business of buying and selling computers. Do I need to know the cost of my computer?
Oh, yeah, sure.
Yes.
Yes.
Why do I need to know it?
To put a price and sell.
To put a price on sale, right? If I don't know my cost of the computer, can I make money?
No.
No.
I mean,
No.
yeah,
I mean, like a 50-50, right?
yeah,
It's
you
here-
wanna know.
Yeah,
but
I want to know until I run the reports.
yeah,
And then I see, but again, I'm on 50-50 here. One option is I to sell it above the cost. The other option is just I to lose the money, right? Those are the two options. So that's why it's important for you to know the cost of your products, whatever you're selling, before you sell it, not after, which makes total logical sense. Right? So for that reason, we need that cost of goods sold. And once we have a cost of goods sold, once I sell the item, I know exactly how much I make. Now, the technology is so fast right now and so advanced. So it was advanced before. Let's face it, that technology on that in this area hasn't changed that dramatically. But imagine this: you're going to superstore, you're buying milk. So you're going to the cashier. The line stays beep. What's happened there? Well, they happen two transactions happen right away. First transaction is to show the sale of the milk, right? Shows the sales and then shows the cash that you have to pay. The second transaction that happened is to deduct the inventory because the milk is now in your hand, not longer in the store, and to show you the cost of the milk. So right at that time, you already know how much you're making by selling selling 1 jug of milk. Why? Because you have the selling price of the milk and you have the cost of the exactly the same milk. And you can see how much you're making from that milk. And you can do that with everything pretty much. As soon as you sell it, you know how much you're making. Right there. So now let's go back to slides and repeat this one more time. You know what people say, right? People usually say the repetition is mother of the knowledge. But don't repeat too many times because they're also saying that the repetition is father of stupidity as well. So you have to be careful. At some point, we have to stop repeating and start using it. So what do we find out first? Direct material, direct labor, manufacturing overhead is our product cost. In order to have a product, we need all those three. Once we have those three, once we know that those three are our manufacturing product cost, we can combine them. First two, direct material, direct labor, we can call it prime cost. And direct labor manufacturing overhead, we can call it conversion cost. But all the three are product cost. And we're going to have the non-manufacturing cost, which non-manufacturing cost will be directly expensed. So the difference between the product cost and the period cost is the product cost is, for the time being, they're going to be kept in the inventory account until they're sold and become cost of goods sold, where the period cost will be directly expensed on the income statement. Everything at the end of the day is going to go to the income statement. Then we saw that we have merchandising company and manufacturing company. What's interesting with those? Merchandising, buying goods, selling goods, where the manufacturing company producing those goods in before they sell them. So for that reason, merchandising company is going to have only one inventory account, which is merchandising inventory or just simply inventory, where the manufacturing company is going to have three inventory accounts. They're going to have a raw material account, they're going to have work in process account, and they're going to have finished goods account. So in order to find out how much is the cost of goods sold, we have to sell the finished goods. So how are we going to find the cost of goods sold? Let's make it a little bigger. For the merchandising company, well, we're going to have to find out how much is our beginning balance of the inventory. Then we're going to see how many we purchased. And we're going to have how many we have available that we can sell. We're going to sell what we're going to sell. At the end of the period, we're going to check the ending balance. We're going to deduct the ending balance, and we're going to see how many we have sold. This is for merchandising company. Now, for the manufacturing company, we're not going to go get it from the merchandising inventory. We're going to get it from the product that we produced, which will be called, in this case, finished goods. So what we have to do, we have to modify the terminology a little bit, adjust your mindset now, and you know that finished goods is the final account of all the three inventory accounts. So the first one, what we have to do is to get the beginning balance of the finished goods. Once we get the beginning balance of the finished goods, we have to add to those one cost of goods manufactured. So the products that we manufactured, we're going to add their cost in our finished goods because they're available for sale. And that's how we're going to get the finished goods available for sale. We're going to sell during the period whatever we sell, and at the end of the period, we're going to deduct the ending balance. Once we deduct the ending balance, we're going to get the cost of goods sold. Now, in any account, T account, what we have to remember is beginning balance plus the additional is always equal to the ending balance plus whatever was taken away from the account. One slightly modification here will be beginning balance plus what we adding to the account is going to give us available. Once we deduct the ending balance, once we deduct the whatever we use, going to give us ending balance. But if we deduct the ending balance, we're going to give us how many we deduct from the account. So let's do one test here. If the inventory balance at the beginning of the month was 1,000, you bought 100 and you sold 300. How many you have?
100.
Sorry?
800?
800. Yeah. Anyone having problem with this? Is there anyone who don't get it? We have in the beginning $1,000. We withdraw 100. Now we have 11,000. At the end of the month, during the month we spent 300. How much we have in our bank account? 800. Now we can change it to the inventory account. We can change it to a finished good account, but that's not going to change the numbers. We're always going to end up with 800 ending balance. Okay, so let's go with, again, 800 we have. So now, we have to prepare the schedule cost of good manufacture. Now, the schedule for cost of good manufacture is the one that we're going to have assignment. This assignment on chapter 1 and 2, I believe, having this manufacturing overhead cost of good manufactured. But this particular question is going to come for you on the midterm. In order to calculate the cost of goods, material, direct labor, and manufacturing overhead, and also calculate the manufacturing cost, which is associated with the finished goods that are finished during the period. So for that reason, with this schedule for the cost of goods sold. So how are we going to start? We're starting with the raw material account first. We're getting beginning balance of the raw material account. Then we're going to add the purchase of the raw material. And then we're going to have raw material available for use. We're going to deduct the ending balance of the raw material, and we're going to see how much raw material we use in our production as a direct material. Then into direct material, we're going to add direct labor manufacturing overhead. That will be our product cost. And this cost, direct labor and manufacturing overhead, will be the conversion cost. But all three together will be our product cost. And that's going to give us total manufacturing manufacturing cost for the period. In order to get my total product, I have to add the beginning balance. Once I have beginning balance plus the manufacturing cost, which is direct material, direct labor, manufacturing overhead, I'm going to have the total work in process for the period. Once I deduct the ending balance of the work in process account, I'm going to have my cost of goods manufactured. Once I get the cost of goods manufactured, they're going to go to the finished goods. But in finished goods account, I'm going to start with the beginning balance of the finished goods plus the cost of goods manufactured. That's going to give me cost of the finished goods available for sale. Once I deduct the ending balance, I'm going to get cost of goods sold. So how exactly the flow of the cost going? Well, we're going to have, again, we're going to split if we slice it from here, if I put the line right here, you're going to see this part here is the product cost. This one here is the period cost. Period cost directly is expensed. Product cost, not yet. First, we're going to have raw material, which raw material is going to stay on the balance sheet as a raw material. But since we don't need the raw material for anything, we better start using in the production. So we're going to start using it in the working process. direct material in the work in process account is going to meet with direct labor and the manufacturing overhead, which is our product cost. Once we have the product ready, it's going to become a finished goods inventory. Once we sell that inventory, then become a cost of goods sold, and that at that point is going to move to the income statement. So you see, at the end of the day, everything is going to go to the income statement, just the timing is different. Let's see another chart here, which will be example with the manufacturing cost. And now let's see here direct material, direct labor, and overhead, manufacturing overhead. They meeting all three together, meeting in the work in process account. From the work in process account, once they finish, once we say, okay, the product is done, manufacturing process is complete, they're gonna move to the finished goods as a cost of goods sold, cost of goods manufactured. Once they're sold, they're gonna move from the finished goods in the cost of goods sold account. Where everything else, selling administrative expense, they will be directly expensed. So, quickly cost of the summary. So far, we saw where the cost is reported. First, we saw that we have inventoriable cost, which is our product cost, which stays on the inventory accounts for the time being, which is direct material, direct labor, manufacturing overhead. And we have the period cost, which is directly expense. So our product cost is the one that stays on the balance sheet until we sold, which is again direct material, direct labor, manufacturing overhead. Now, based on how the costs behave, we're going to talk in just a few minutes. We're going to have the variable and fixed cost. The way how we are assigning the cost to the cost object, we're going to have direct cost and the indirect cost. And for the decision making, we're going to have all the different options for the costs. So now let's go to one a little bit complicated assignment and see how we're going to deal with this. First one, beginning raw material. Now let's get the cost of goods sold here. That's the objective here. But let's start with the raw material. Raw material inventory was 32,000. During the month, 276 raw material were purchased. At the end of the month, we found out that we have 28,000. What is the cost of direct material used? Sorry?
180.
280.
280, yes. How we get it? 32 plus 276 minus 28. And we're going to get 280. Okay, we found the raw material used in the production. Good. Let's move on then. Direct material used in production, 280, the one we calculated. Direct labor is 375. Manufacturing overhead was 180. What's our total manufacturing cost? Or what's our product cost?
$835.
835. Once we
Yes.
combine those three together, we should get 835. So now, 835 is where we are. Not this one here. 835 is our total cost for the month. Now let's see. Beginning balance on the work in process is 125. Manufacturing cost for the period is 835. At the end of the month, there were 200 partially finished goods that's sitting at the ending balance on the work in process account. Now the question is, how much is the cost of goods manufactured?
$760,000.
760, like letter C.
Letter C. Let's see if that's the case. Yes, it's 760. How we get it? Beginning balance plus the total manufacturing cost. Gonna give us available minus the ending balance, gonna give us how much is the cost of goods manufactured. Next one. Finished goods. Let's find the cost of goods sold now. Finished goods beginning balance 130. We manufacture for cost of goods manufacturing 760. Ending balance of the finished goods at the end of the period is 150. How much we sold?
Letter
700.
B.
Letter B, 740. Awesome. So now, let's finish with this product cost and let's move out now to the how the costs behave. Now, costs behave two ways. This is within period of time and period of production. They behave as a variable cost and they behave as a fixed cost. Now, what's the variable cost? What's the fixed cost? And how those behave. Variable cost, first the total variable cost, you can see it as a cost that we're paying on everyday usage. If we don't use it, if you don't buy anything, we don't have to pay. But once we start buying it, that cost gonna exponentially grow. Cost, what I want you to understand is the cost a mathematical function of two variables. One variable is number of units that we're purchasing. The second one is the cost per unit. So if I buy 0 pizza, I have, even though the pizza costs, let's say $15, I'm gonna pay $0. But that doesn't change the fact that the pizza costs $15. Make sense? But if I buy one piece of pizza which costs $15, I have to pay $15. If I buy two pieces of pizza which costs $15 per piece, I have to pay $30. So what drives my total cost? Number of the pizzas that I'm purchasing. The cost per pizza stays the same. Make sense? So more I'm using the pizza, more pizza I'm buying, more I have to pay. If I don't buy a pizza, I don't have to pay. But that doesn't change the fact that the pizza itself costs $15. I'm not paying anything because I'm not buying anything. Now let's see. Again, the variable cost per pizza is going to stay the same, $15, and that's not going to change. So for that reason, the variable cost, you have to understand, they behave in two ways. First way is per unit. Second one is in total. Per unit, variable cost always stays the same. It doesn't change. Price per unit doesn't change. But the total price that we have to pay, it changes in proportion of the amount of the quantity that we're getting. So what's going to drive that cost? Well, different things. In our manufacturing company, units are producing. If we want to produce more units, which we can sell, we have to have more cost. More we're producing, more we have to spend. Machine hours. If we don't use our machine, cost per machine hours will be 0. But if we use it more, cost is gonna go more. And usually we want to use the machine more because by using machine more, we're going to produce more units. Once we produce more units, we're going to make more money. Next one is the miles driven. If you don't drive your car, you don't have to pay. More you're driving, more you have to pay. Labor hours. If you don't need labor hours, you don't have to pay for those. But more you using your labor workers, more you have to pay. So those are the ones who usually driving the variable cost. Now let's see what now is the fixed cost. Fixed cost is the cost that behave in the very specific way. That means that in total is always going to stay the same. Example for the fixed cost will be, let's say, the monthly compass card. Once you pay for the monthly compass card, you don't have to pay again. You pay for the full month. Once you pay your monthly rent, and that's for the period of time. So that's it. Once you pay once, you don't have to pay every morning the same amount. You pay it once and then you're using it for the entire month. So the total cost, the total fixed cost or fixed cost in total always stays the same. Now let's see how will be per usage. So now imagine this, you buying that monthly compass card for the public transit and you decide to go on vacation for the entire month. How much will be your total cost? It's going to be cost for the, let's say you spend $150 for the monthly compass card for the public transit. Once you purchase the card, you have to go you decide to go on vacation for 1 month, so you're not using the card at all. Would you get your money back? No, you won't. So how much is the cost? $150 for you. Now, if you use the compass card only once to go to the airport, how much that trip cost you? Well, that will be $150. Why? Because you're using it once, you pay $150, that trip cost you $150. What if you use the compass card 2 times in a month? How much will be the cost per trip? And you're paying $150. It's going to reduce by 2, right? So it's going to be $75. How about if you use the card 10 times per month? How much will be the cost per trip? Are you guys with me?
15, yes, Prof.
$15, right?
Yep.
So what's your incentive here? To use your card as many times as you can. Because that's how you're going to reduce the cost per unit. Make sense? So we come here to the point that how can I utilize my fixed cost in order to get the maximum benefits? By using the fixed cost as much as you can. That's how you're going to reduce the fixed cost per unit and you're going to get the maximum benefits from that fixed cost. Same thing with the rent. If in one bedroom, for one bedroom you pay, let's say, $1,000 and one person living there, how much is the cost per person? $1,000. If 2 people living there, how much is the cost per person?
500.
500. If 4 people living there, how much is the cost per person now?
250.
150.
250, right? So you can see how the cost per person keep going down, keep going down, keep going down. What's the incentive here? To put in that one bedroom as many people as you can. Now, that's the only way to reduce the cost per person. Okay, we're going to talk about the cost behavior a little bit more in the next chapter, chapter 3. Now let's see what's the relevant range. Relevant range is the range of activity where the variable cost per unit stays the same and fixed cost in total stays the same. So relevant range for the compass card will be a month. Relevant range for the rent will be month. but also will be the number of bedrooms. For the compass card, again, relevant range will be first per month, and second relevant range can be what kind of zone that monthly pass cover. Is it for one zone? Is it for two zones? Is it for three zones? So you can see the cost, the total cost is going to change. For per month is going to stay the same, but if you're moving from one zone to two zones, you have to pay more. So variable cost, again, we're going to repeat this one more time today. Variable cost in total always changes with the level of activity. More you're using it, more you have to pay. Less you're using it, less you pay. Not using it, not paying. But per unit, always going to stay the same. It doesn't matter how many pound potato you're buying, the pound price per pound potato is $1. If you don't buy, $1. If you're buying 10 pounds, $1 per pound. Fixed cost. Fixed cost, on the other hand, in total always stays the same. Once you pay for your car insurance, cost you're paying, let's say, $1,000 for the car insurance, that's how much the cost is for the entire year. But per unit, well, if you translate the cost per kilometers, now more you driving your car, less the cost of the insurance per kilometer is going to go down. Let's do this quick check here. And the quick check is, which of the following costs will be variable with respect to the number of cones, which is only, we're talking about the cones that we're selling on Baskin-Robbins shop in Metrotown. So, first one, cost of the light in the store. Is this related to the cones that we're selling?
No.
No.
It's a fixed
So
cost.
what will be that? Variable cost or fixed cost?
Fixed cost.
Fixed cost. Wages of the store manager.
Fixed cost.
Fixed cost.
Fixed
Fixed
cost.
cost.
Cost of the ice cream.
That's
Variable cost.
Cost of the napkins.
variable.
Variable, right?
Fixed. Variable.
Variable, because more customers, more napkins.
Okay.
No customers, no napkins, right? Okay, so the last two will be the one, and let's see now how we gonna, different classification was the how we assigning the cost to the object. So assigning the cost of the object will be direct cost and indirect cost. How are we going to differentiate one? Direct versus indirect. Every cost that has adjective direct in front of the cost, in front of the name of the cost, is direct cost. So for that reason, direct material, direct cost. Why? Because it says direct material in front. Direct labor, direct cost. Why? Because it says direct labor. Adjective in front of the cost, labor, is direct. So for that reason, direct cost. Indirect cost. Anything that doesn't say direct is indirect. What that means? That means that indirect material is indirect cost. Indirect labor, indirect cost. Manufacturing overhead, indirect cost. That's with those indirects. Now for the decision making, we're gonna have a different classification. First, in order to make a decision, what we need to have alternatives. If I don't have alternatives, can I make a decision?
No.
Yes, there's nothing to do. So I need at least two alternatives. Once I have those two alternatives, what I'm going to see? I'm going to compare only, and I'm going to consider only the cost and benefits which are different from one alternative versus the other alternative, which makes total sense. So now, let's think about this. You have a job which paying you $1,050 per month. You have a job offer in the closest city, which is going to give you $2,000. But you have to drive and you have to spend $300 for the driving per month. Would you take that? Is that, if you take this job, is that going to improve your cash?
There is no community cost in the hometown, right?
No.
If it's a hometown, he can have whole 1500.
Yeah, you're
But
getting all the 50 for 1,500.
if
on the fir-
he's, then he will have $1,700.
$1,700. So is it, am I with more cash if I get the new job?
Yeah.
Yes. So how are we going to do this? First, we can have, what's the difference between the new job and the old job? $500. But I have to spend $300 more. Whatever I'm spending, is it more than what I'm getting? No, it's not. So actually going to end up with $200 more. When I add $200 into $1,500, I'm going to end up with $1,700. That's obvious here. Now let's see the opportunity cost. Opportunity cost is something that it's important for our decision making, but the interesting thing with the opportunity cost is the cost which is giving up, or the benefits that is giving up if we make one decision versus the other decision. So the opportunity cost is not something that you have to pay, but is something that you have to consider. So right now you are here online and listen this lecture. What's the opportunity? Opportunity is you to working. So the missed wages because you're sitting on the lecture will be your opportunity cost. Sunk cost is the cost that you already paid. Sunk cost is never relevant and it's never considered when you're choosing one alternative versus another alternative. So imagine this: you bought you bought a car for the cost of $10,000 2 years ago. Now the $10,000 is a sunk cost. Why? Because you already paid for it. You cannot change that cost, and through the time, that's whatever decision you're going to make from now on is irrelevant because that cost already been paid, and you cannot change it. Now let's see this quick check. Suppose that you deciding whether to drive or take a train to Portland because you want to go to the concert. Money are not a problem. You have enough cash, so the money is not your constraint here. So you have two options: to drive or to take a train. The question is, should the cost of the train, is the cost of the train ticket relevant for this decision? Or should the cost of the train affect the decision whether to drive or take a train?
Well, they missed that. How far is the Portland?
For Portland, it's about 3,000 kilometers from here.
So I will look for that train because it's less expensive than driving. Because
So no. We don't know the cost of the train. We don't know the cost of the
the
driving.
train ticket,
Right.
yeah.
So the question is the cost of the train ticket relevant for our decision? Would you?
Yes.
Yes. Why? Because it's the one of the cost. The next relevant thing will be the cost of the gas, right? Once we get those two, then we can compare and see which one is cheaper. Before we have those two costs, there's nothing we can do. So now, let's go now. And same thing. We decide to go with the train or the car. Same way to Portland. Again, money are not our problem. Now the question is, the annual cost for the insurance that we pay for the car, is that cost relevant for our decision?
I think no,
What the other people think?
because you cannot change. You
I
have to.
cannot change it, right? That is correct. I cannot change that cost. I already pay for it. Regardless if I'm using or not, nobody's going to give me the money back. So the last question for this chapter, it's a tricky question though. Now, suppose that your car could be sold now for $5,000. Now you can sell your car for $5,000. Is this a sunk cost?
No,
Is this a cost at all?
I think it's a depreciation cost
No. Think about it.
because sunk cost is that is I already paid.
You already paid, but is this a cost? This
No,
is the money that you're gonna get. This is actually
Yeah.
your revenue, right?
cost. This is revenue. Yeah.
Right. So for that reason, this is not cost at all. Okay. So briefly, cost types. For the financial reporting purposes, we have a product cost and we have a period cost. Product cost gonna stay as on the inventory side until it's sold. For predicting the cost behavior, which we're gonna talk more in a few minutes, we have variable and fixed cost. For assigning the cost to the object, we have direct cost and the indirect cost. And the last classification is for decision making, we have differential cost, we have opportunity cost, and we have sunk costs. Okay, that was chapter 2.